Welcome back, focused learners. Today, we're putting signal over noise and jumping straight into one of the most fascinating economic thought experiments of the 20th century. We're breaking down Fisher Black's legendary 1970 paper, Banking and Interest Rates in a World Without Money. So if you're the kind of person who likes to strip away all the dizzying complexities of modern finance just to see how the engine actually works underneath, you are absolutely in the right place for this explainer. Right off the bat, let's hit the core premise. What happens to the economy if money just doesn't exist? Now, to be clear, we are not talking about some post-apocalyptic world where we're trading shiny rocks and seashells. Think of a highly advanced, perfectly functioning modern economy, but one where there is absolutely no measurable quantity of money as we typically define it. We're talking no M1, no M2, no fixed supply of cash acting as the ultimate speed limit on economic growth. And Fisher Black wasn't exactly a lone wolf here. He was building on the work of some heavy hitters, economists like William Vickery, John Gurley, and James Tobin. Actually, Tobin hit the nail on the head back in 1969. He essentially argued that if all financial assets were perfectly flexible, well, there would be absolutely no room for monetary policy to affect aggregate demand. The real economy would call the tune for the financial sector, not the other way around. Traditional monetary policy, completely powerless. Section 1. Uncontrolled banking, the rules of the game. To really grasp how a world without monetary policy functions, we have to look at the environment Black sets up. The foundational concept here is uncontrolled banking. Basically, it's a completely laissez-faire financial system. Banks are free to offer checking and savings accounts on literally any terms they see fit, and they can pay full interest on demand deposits. But here is the absolute kicker: zero reserve requirements. And without reserve requirements, the central bank's primary lever for manipulating the banking system, it literally just vanishes. So in this world, how does a bank account actually work? It's brilliantly simple. It's just a ledger system. You don't have a checking account over here, a savings account over there, and a mortgage account somewhere else. You just have one single account. If you spend less than you earn, you float into a positive balance. That acts as your savings, and it earns the wholesale interest rate. But if you spend more than you earn, your account just dips below zero into a negative balance. No massive loan approval paperwork, the bank just charges you that same wholesale interest rate plus a minor fee for the service. Let's walk through how a transaction plays out in real time. Say a buyer wants to purchase something. They write a check or swipe a card. All that happens is their negative balance increases. Boom, step 1. Step 2, the seller receives that payment, which instantly increases their positive balance. Step 3, and this is the crucial part, nothing new was created. No printing presses fired up. The total wealth in the system merely shifted from one column to another on a giant master ledger. It is all just an accounting entry. Section 2. Evolution of payment systems, from barter to the ultimate ledger. Now, if you're thinking, okay, this sounds a bit like science fiction, Black actually argues this is the completely natural trajectory of human commerce. Humanity constantly seeks out efficiency. We start way back at step 1 with physical barter and commodity money like gold, which is incredibly inefficient because you're literally tying up usable resources just to make a trade. From there, we hypothetically evolve. We move to trading shares of stock, then to writing personal notes to each other, then having banks step in to guarantee those notes, until eventually we arrive at pure bank money, the ultimate ledger system. Notice the trend? As we progress, the physical nature of money completely evaporates. Which brings us to a really profound conclusion. The moment you introduce sophisticated financial markets and completely intangible means of payment, the whole concept of a quantity of money loses all economic meaning. You literally cannot put a strict number on the money supply anymore because anyone can theoretically just write a note or float a negative balance. You can't measure an illusion. Section 3. The central bank illusion. Why the Fed becomes obsolete. So think about it. If you can't measure the money supply, what in the world happens to the institution whose entire job is to manage it? It sets off a massive domino effect. Why do central banks lose control? Well, first off, there's no distinct quantity of money to regulate anyway. Second, remember those zero reserve requirements? That means the Fed's classic tool of open market operations is completely useless. There are zero reserves to squeeze or expand. And it gets wilder. The federal government wouldn't even issue special treasury bonds. They would just borrow from commercial banks exactly like you or I do by running a negative balance. Imagine the U.S. Treasury just casually running a multi-trillion-dollar overdraft. And Fisher Black takes this a step further. He looks at the regulations central banks do impose right now, and he argues they aren't actually managing the economy at all. They're just creating massive inefficiencies. It's fascinating. If a central bank caps interest rates on deposits, it just triggers a supply and demand imbalance. If they force banks to hold reserves, it functions as nothing more than a hidden tax on bank deposits. And if they artificially limit those reserves, they just spawn a black market where banks furiously trade reserves at inflated prices. In Black's view, the central bank isn't steering the ship, it's literally just throwing friction into the water. Section 4. Rewriting economic rules. Debunking traditional theories. Because this pure ledger world operates so uniquely, Black uses it to just completely shatter textbook macroeconomic theories. Let's start with the big one, the myth of aggregate demand. Traditional macro says, hey, the central bank lowers rates, borrowing gets easier, and total demand in the economy magically goes up. Black's logic tears that apart. In a closed ledger system, every single loan absolutely must be matched by a deposit. So if person A borrows and spends more, it mathematically requires that person B decided to save and spend less. Borrowing precisely equals lending. That means the overall aggregate demand of the economy remains exactly the same. You're just shifting who is doing the spending. You aren't increasing the total amount of it. Next up on the chopping block is the quantity theory of money. You know the famous saying, too much money chasing too few goods causes inflation? Let's walk through why that fails here. Step 1, all transactions are just ledger transfers. Step 2, every loan created is perfectly matched by a deposit, meaning those deposits can always be used to pay down the loans and extinguish them. Step 3, because the system is perfectly balanced internally, and there's no autonomous quantity of currency being injected from the outside, the banking system can't independently bid up asset prices and cause systemic inflation. The math is simple. If you can't measure the money can't chase the goods. The theory completely fails. Finally, Black takes aim at Keynes's liquidity preference theory. This is the idea that if people suddenly want to hold more cash instead of investing it, it damages the economy. Black says, nope. Also invalid. In a frictionless banking world, if you adjust your portfolio from currency to a bank deposit or from stocks to a loan, that is a purely financial action. If you want more cash, the bank hands it over. If you want less, you deposit it back. It is purely accounting. It's exactly like pouring water from a cup into a bowl. It has absolutely zero impact on the real production of goods, real employment, or real prices. So, where does this explainer leave us? Fisher-Black's framework drops a pretty stark realization right in our laps. If money isn't a physical thing to be hoarded or printed, but merely an accounting illusion on a master ledger, well, who actually controls the economy? According to Black and the economists who share this lens, it sure isn't the central bank. It is the real economy. Real people making real goods, exchanging real value. That is what calls the tune. The financial sector, it's literally just the scoreboard. Keep questioning the fundamentals, and I'll see you in the next one.